You've been grinding for years. You've said no to countless impulse purchases. You've automated your savings. You've watched your portfolio grow month after month. And finally, you check your account and see it, $350,000. For a moment, you feel like you've made it. You feel proud. You feel wealthy. And that feeling, that intoxicating, well-earned feeling, is the most dangerous thing that will ever happen to your financial future. I'm Hamster. I've spent years studying why some people become millionaires while others with similar income stall out right when they're closest to success. Today, we're diving into what I call the $350,000 illusion. By the end of this video, you'll understand why this number is not a finish line. It's a minefield. Most people think wealth grows in a straight line. Save $10,000, you're $10,000 richer. Save $100,000, you're 1/10 of the way to $1 million. Simple, predictable, linear. But the reality is exponential. And there are specific dollar amounts where the psychology of money flips completely. $350,000 is one of those numbers, and it might be the most dangerous one. Where does all that money go? It's not just about bad spending habits or unlucky market timing. It's about psychological traps that activate at specific wealth levels. The biggest trap of all sits right around $350,000. Let me tell you a story about two investors. Both started with the same income, same savings rate, same investment strategy. By age 40, both had exactly $350,000. One went on to become a millionaire by 55. The other lost half his portfolio and never recovered. The difference wasn't luck. It wasn't market returns. It was what happened inside their heads at $350,000. Here's what happens when you cross $350,000. Your money starts moving faster than you do. A single good day in the market can earn you more than your entire weekly paycheck. A strong month can generate more passive income than some people make in a full quarter. But this is also the point where one bad decision can erase years of progress. Let me put it in perspective. When you have $8,000 invested, a 15% loss costs you $1,200. That hurts, but you can recover. When you have $350,000, the same 15% loss costs you $52,500. That's more than the average American's entire annual savings. The stakes aren't just higher, they're in a completely different universe. But the real danger isn't the potential losses. It's what happens inside your head. I call it the illusion of arrival. You check your account on a random Tuesday and see you're up $9,000 from yesterday. Your brain instantly starts calculating $9,000 in one day. That's more than you used to make in a month at your first job. You're clearly doing something right. You deserve to celebrate. Maybe it's time for that vacation you've been putting off. Maybe you should finally upgrade your car. After all, you're practically rich now, right? Wrong. Dead wrong. And here's what's actually happening at $350,000. You are not rich. You are not even close to rich. What you are is dangerous to yourself, to your future, to the wealth you've worked so hard to build. You have just enough money to make really expensive mistakes, but not enough to recover from them quickly. That $9,000 gain you saw? It's unrealized. It exists only on paper, only in the digital ether of your brokerage account. It can disappear tomorrow just as quickly as it appeared. But that $12,000 vacation you're considering? That's very real, very permanent, and very capable of setting your wealth-building journey back by months or even years. This is what I call the dangerous illusion. Feeling wealthy before you are wealthy. And it destroys more financial futures than market crashes, recessions, and bad investment advice combined. Let me give you a concrete example. I once knew a guy, let's call him Mark, who hit $380,000 in his portfolio at age 38. He was thrilled. He'd been saving aggressively for 15 years. He decided he deserved a reward. He took $45,000 out for a luxury SUV and a 2-week trip to Europe. 5 years later, his portfolio was still under $400,000. If he had left that $45,000 invested and continued his regular contributions, he'd have been over $600,000. That one reward cost him over $200,000 in future wealth. He felt wealthy, so he acted wealthy. That's the trap. But the illusion of arrival isn't the only trap. There's another one, even more destructive. I call it the overconfidence monster. Psychologists call it the Dunning-Kruger effect. Here's how it works. You've saved $350,000. You've weathered a couple of market downturns and come out ahead. You start thinking you understand how this wealth building thing works. You start believing you're some kind of investing genius. And that's when things go off the rails. Conservative index fund investors suddenly think they can pick individual stocks. People start dabbling in options trading, chasing meme stocks, throwing money at speculative real estate deals. The cruel irony is that at $350,000, you finally have enough money to make serious mistakes. You can afford to lose $15,000 on a bad stock pick, $25,000 on cryptocurrency, $60,000 in your friend's restaurant venture. The problem is, being able to afford losing and being able to survive losing are two completely different things. One bad decision at this level can erase 3 to 6 years of compounding growth. 3 to 6 years of discipline, gone. And then there's the third trap, the quietest, but no less deadly, the comparison trap. You finally hit $350,000. For a moment, you feel successful. You look at your peers who are still living paycheck to paycheck and you feel proud. Then you meet someone at a networking event who mentions they have $600,000 invested. Suddenly, your $350,000 doesn't feel so impressive. Then you read an article about someone your age with $900,000. Now you feel behind. Then you see a social media post flaunting a $3 million portfolio. And suddenly, you feel like a complete failure. This is where people sabotage their own progress. They abandon their conservative approach. They start chasing higher returns. They increase their risk tolerance beyond rational limits. They make desperate moves to close the gap. But the comparison trap is never ending. There will always be someone with more money. Even billionaires compare themselves to other billionaires, and at $350,000, you have just enough money to start making really stupid decisions in the name of catching up. Here's the brutal truth. $350,000 is the most dangerous point in your entire wealth building journey. You have enough money to do real damage, but not enough to insulate yourself from your own bad decisions. And here's the paradox. The secret to navigating this level isn't about starting something new, it's about stopping the urge to be clever. You don't need to get fancy. You don't need to pick individual stocks. You don't need to diversify into REITs, commodities, or emerging markets. You don't need to hire a financial advisor who'll charge you 1.5% a year to tell you to do what you're already doing. What you need is to keep doing exactly what got you to $350,000 in the first place. But here's why that's so hard. When your account balance is jumping around by thousands of dollars every week, staying boring feels like you're leaving money on the table. Your brain shows you all the what ifs. Look at that stock that went up 400% last year. Look at that real estate deal that would have doubled your money. Look at that crypto that made people millionaires. This is where discipline becomes more valuable than intelligence, where the ability to ignore noise becomes more important than the ability to analyze opportunities, where boring becomes beautiful. Let's run the numbers. If you have $350,000 invested, earning a conservative 7% annual return, that's $24,500 in growth per year. $24,500. That's more than many people save in their entire lifetime, and your money is generating that every year without you lifting a finger. But it gets better. Because of compound interest, that $24,500 starts earning its own returns. Next year, you're earning 7% on $374,500. The year after, on $400,000. The snowball accelerates. Here's the part that will blow your mind. The journey from $350,000 to $700,000 takes about half the time it took to get from $0 to $350,000. The second $350,000 comes twice as fast as the first. The third comes even faster. I call $350,000 the point of no return. Not because you can't lose money from here, but because if you can resist the psychological traps at this level, building serious wealth becomes almost inevitable. Your money develops momentum that becomes harder and harder to stop. Let that sink in. If you never added another dollar, your $350,000 would grow to $1 million in roughly 15 years. That's the power of compound interest once you have a critical mass. But there's something else that happens at $350,000, something almost nobody talks about. You gain freedom of choice. You can't retire on $350,000, but you can make career moves that paycheck to paycheck people simply cannot consider. You can take a temporary pay cut to join a startup with equity upside. You can negotiate more aggressively with your employer because walking away isn't financial suicide. You can relocate for better opportunities without worrying about moving expenses. Let me give you a real example. A friend of mine, let's call her Priya, hit $380,000 in her portfolio at 42. She was miserable in her corporate job but felt trapped. With that safety net, she quit, took a 30% pay cut to join a small company she believed in, and worked on a side project. 4 years later, her side project became her main business and her income doubled. Her portfolio, even with lower contributions, had grown to $550,000. The freedom to leave a bad situation was worth more than the extra salary she gave up. I want to share something that most financial advisors won't tell you. The difference between people who build lasting wealth and those who sabotage themselves at this level often comes down to 3 simple rules. Rule number 1, don't get clever. Keep buying low-cost index funds. Don't try to beat the market. The odds are stacked against you. Even professional fund managers fail at market timing over long periods. Rule number 2, don't compare. Other people's success is not your failure. The only person you're competing with is the person you were yesterday. Social media is a highlight reel, not a balance sheet. Rule number 3, don't accelerate. Your money has already gained momentum. The smartest thing you can do is nothing at all. Don't take on leverage. Don't borrow to invest. Don't try to supercharge your returns with risky bets. That's it. The $350,000 illusion isn't about what you should do when you hit this milestone. It's about what you absolutely should not do. Stay boring. Stay disciplined. Let compound interest do what it does best. Let me tell you a story about 2 real people. Names changed, but the numbers are real. Sarah hit $350,000 at age 40. She felt the illusion of arrival. She upgraded her apartment, bought a luxury car, and started treating herself more often. Her savings rate dropped from 20% to 8%. She also started dabbling in individual stocks, thinking she could beat the market. By age 50, her portfolio was only $550,000. She had added money, but her returns were mediocre, and her spending had eaten into her potential growth. James also hit $350,000 at age 40. He kept living in the same modest apartment, driving the same used car, and investing the same boring index funds. He ignored the noise. He didn't compare himself to others. By age 50, his portfolio had grown to $850,000, with no additional contributions beyond his regular 20% savings rate. He was on track to hit $1.5 million by 60. Same starting point, same income. Completely different outcomes. The difference wasn't intelligence or luck, it was discipline at the critical moment. One of the biggest fears at $350,000 is a market crash. You've worked so hard to get here. The thought of losing $70,000 or $100,000 in a downturn is terrifying. Here's what you need to understand. Market crashes are not the enemy. Selling during a crash is the enemy. If you had $350,000 in 2008 and did nothing, you would have recovered fully by 2011 and more than tripled your money by 2021. If you sold at the bottom, you would have locked in your losses and missed the recovery. At $350,000, your job during a crash is to do nothing. Turn off the news. Don't check your portfolio every day. Keep contributing. If anything, increase your contributions when prices are low. Another common trap at $350,000 is leverage, borrowing money to invest. You might think, if I can borrow at 6% and earn 8%, that's free money. Here's why that's dangerous. Leverage amplifies losses as well as gains. A 10% market drop becomes a 20% loss on leveraged money. And if the market drops 30%, you could lose everything. I've seen people with $350,000 portfolios take out home equity loans or use margin accounts to invest more. Then a correction happens, they get margin calls, and they're forced to sell at the worst possible time. Don't do it. There's another psychological trap that hits around $350,000. You start thinking, I'm so close to $500,000. If I just work one more year, save a little more, take a little more risk, I can get there faster. This is the one more year syndrome. It's the feeling that you're almost there, so you should push harder. But pushing harder often means taking unnecessary risks or burning out. The truth is you're not almost there. You're on a long journey. The marathon doesn't end at $500,000 or $1 million. The goal is financial freedom, not a specific number. Don't sprint in the middle of a marathon. One of the hardest parts of reaching $350,000 is the social pressure. Friends and family start to notice that you're doing well. They might make comments about your frugal lifestyle. They might expect you to pick up the tab. You might feel guilty for not spending more. You might feel like you should upgrade your life to match your wealth. Here's the reality. Most of those people are not wealthy. They're financing their lifestyle with debt. They're one paycheck away from disaster. Your boring, disciplined approach is the one that leads to real freedom. If someone asks why you still drive an old car or live in a modest house, you can simply say, "I'm saving for something important." That's true. You're saving for your future freedom. So if you shouldn't change your strategy, what should you do when you hit $350,000? Here's a simple checklist. Rebalance your portfolio. If your asset allocation has drifted, bring it back to your target. Sell some winners and buy some laggards. Review your emergency fund. Is it still 6 to 12 months of expenses? If not, top it up. Check your insurance. Do you have adequate health, disability, and umbrella insurance? Wealth needs protection. Update your estate plan. Do you have a will? Beneficiaries on your accounts? It's time to get serious. Ignore the noise. Don't change your contribution rate. Don't get fancy. Stay boring. That's it. No secret investments, no exotic strategies, just boring, disciplined maintenance. Let me show you why $350,000 to $1 million is not as hard as you think. Assuming a 7% annual return and no additional contributions. Year 0, $350,000. Year 5, $490,000. Year 10, $690,000. Year 15, $970,000. Year 16, $1,040,000. That's with no additional savings. If you continue saving even a modest $10,000 per year, you'll hit $1 million in about 12 years. The key is to not sabotage yourself. Every dollar you lose to a bad investment or a luxury purchase is not just a dollar lost, it's years of compound growth lost. Let's talk about the emotional side of $350,000. Your portfolio will have days when it drops $10,000. It will have days when it rises $15,000. This can be emotionally exhausting. Here's how to stay sane. First, stop checking your portfolio daily. Check it once a month or once a quarter. The daily noise will drive you crazy. Second, remind yourself of the long term. Zoom out. Look at a 20-year chart. The trend is your friend. Third, have a hobby. Seriously, do something that has nothing to do with money. Exercise, read, garden, play music. Distract your brain from the numbers. When you have $350,000, you have something worth protecting. If you die without a will, the state decides where your money goes. That's probably not what you want. Get a simple will. Online services make this easy and cheap. Name beneficiaries on all your accounts: 401k, IRA, brokerage, bank. Consider a living will and healthcare proxy. Estate planning is not glamorous, but it's part of being a responsible adult with assets. Spend a few $100s now to save your family a lot of stress later. At $350,000, your investment income is becoming substantial. Dividends, capital gains, and interest are all taxable. If you're not careful, you could be giving away thousands of dollars to the IRS unnecessarily. Use tax-advantaged accounts first: 401k, IRA, HSA. Consider tax loss harvesting to offset gains. Hold investments for more than a year to get lower long-term capital gains rates. If you're in a high tax bracket, consider municipal bonds for tax-free income. Don't let taxes eat your returns. A little planning can save you tens of thousands over time. Finally, let's talk about what comes after $350,000. The same principles apply. Stay boring, stay disciplined, ignore the noise. But there's one additional shift. At $350,000, you're no longer building wealth just for survival. You're building wealth for options. You're building the ability to say no to things you don't want to do and yes to things you do want to do. The people who make it to $1 million aren't the ones who got lucky or took huge risks. They're the ones who stayed the course when it was boring, when it was hard, when everyone else was chasing the next shiny object. You have what it takes. You've already proven that by getting to $350,000. Now the only thing standing between you and $1 million is yourself, and your ability to resist the traps. The $350,000 illusion is real. It's the point where you feel wealthy before you are wealthy. It's the point where your brain tries to trick you into making expensive mistakes, but you now know the traps. Stay boring, stay disciplined, let compound interest do what it does best. Your future millionaire self is waiting. I'm Hamster. Subscribe for more real, no BS finance.